Good afternoon, it's Jeff Christian. It's May 7th, Friday, around 12:25 here in New York. Wanted to talk to you a little bit about today about the gold prices. Gold prices have risen sharply over the last couple of days, and what we see going on behind that, and then also give you a little bit of a preview of our silver yearbook. The silver yearbook's coming out next Tuesday, the 11th, and we've packed a lot of extra stuff in it, given some of the developments that have been going on in the silver market. So today I have a variety of topics. I want to talk about the rise in gold prices yesterday and today. CPM Group had actually drafted a trade recommendation, one of our 5-day, 10-day short-term trade recommendations yesterday morning, where the price was around 1792, and we said this thing could go up to 1815. And within 10-15 minutes before we even sent out the trade recommendation, the price was 1814. The price this morning was about 1839. We issued a new press trade recommendation saying that we thought that the price could go to about 1850, a little bit more upside. Silver broke above $27 yesterday. It's gotten as high as 27.80. We think it could get to 28. We're not sure that there's much more steam in the next 5 days in these prices. And quite frankly, after 2 days of sharp increases, especially with gold and copper and the stock market and a variety of other factors, there could be some profit taking early next week or even this afternoon as far as that's concerned. The rise in gold prices didn't happen by itself. I mean, copper prices were up 10 cents at one point earlier this morning. I'm not sure where they are now. The stock market rose very sharply in the United States yesterday, and it was up strongly this morning. It's kind of a little bit strange. You see a very bad employment report. Well, maybe not so bad, but much worse than the Wall Street expectations had it likely to come out. You saw a pretty weak employment number, and asset prices rise. It's because the asset prices are looking at interest rates as opposed to overall economic real conditions. Interest rates are that much less likely to rise sharply soon now, given some weak economic indicators, including today's employment figures. That is probably the primary thing that's affecting gold and silver prices right now. We're also moving into a period of seasonal weakness. Janet Yellen, well, yeah, it's interest rates, it's interest rate expectations, which are very important, and it's inflation expectations. You're seeing these reports, oh, well, copper prices are up sharply, and lumber prices are up sharply, and this price is up sharply. And they're being taken as a generalized view that there's a lot of inflationary pressures. There are some longer term inflationary pressures in the market. There are some shorter term isolated types of pressures. And we talked about this last week, I believe. And there are a lot of deflationary pressures in the longer term economic outlook, which could keep interest rates from rising, inflation from rising sharply, but also interest rates. So a lot of it has to do with actual interest rates, but a lot of it also has to do with expectations of interest rates and expectations of inflation. I made a comment last week that I wanted to base off of. I said that some people thought that Janet Yellen was a better economist than she had been as a Fed chairman. And some people clearly misunderstood what I was saying. The view was expressed that Janet Yellen didn't necessarily express herself well as the Fed chairman. Central bankers are masters of linguistics. They speak their own language. One of the jokes when Alan Greenspan was the Fed chairman was that no one understood him when he talked except me. I understood him perfectly because that was central bank speak. And after he left, the central bank tried to get a little bit less opaque and more plain English. And Janet was doing that very well, and it sometimes roiled the markets. Last week, she said something to the effect that, hey, if there are inflationary pressures that do come into the economy at some point in the future, interest rates may have to rise. And it roiled the market. People say, oh my God, she's telling people that the interest rates are going to rise. She corrected herself the next day and said, look, I said that if there are these inflationary pressures in the future, they may lead to higher interest rates in the future. I'm not predicting it. I'm not saying that we're going to be raising interest rates. I'm just saying let's be economic realists. And it wasn't that she was clumsy in her language. She was being extremely smart and intelligent in her language, and she was making a tactical move to send a message to the broader financial markets that let's be realistic. If there are inflationary pressures in the future, the Fed can in fact raise interest rates. And it has other instruments that it can work on to try to lean into the breeze of inflation before it becomes a wind. So I don't think that that's a big issue, and I don't think it's a problem. And I wanted to correct any misunderstandings about what I said. And I wanted to say, look, that's what she was saying. She was telling the market, let's be realistic. Interest rates could rise, could be years from now. Interest rates could rise if inflation becomes a problem. Now, CPM Group released its May Precious Metals Advisory last night, Thursday night, the 6th of May. You can buy a single copy at the link below. You go to cpmgroup.com to our store. You can buy a subscription to the full year. You can buy a single copy. The title says it all, Buy the Dips. And we talked last week about our expectation that you could see prices move sideways with some downward movements over the next 5 months, the remainder of the second quarter and the third quarter. There's some seasonality there. There is growing optimism about the economy despite the employment and other figures. We are still in a recession. We have not gotten back to the previous peak in terms of real economic output, and employment is still a problem. The recovery that we've seen so far has been extremely spotty and has missed major portions of the population and the overall economy. But we are moving in the right direction, and there is a rising amount of optimism. It's not at the point of irrational exuberance yet, but people are more optimistic about the next 6 months and the next 2 years than they have been probably for the last 6 months or the last year or so, 2 years. So we're saying buying the dips because we do think that precious metals, gold and silver, platinum, will be rising in the next 2 years and in the next 10 years, or within the next 10 years. And that if you see weakness in the next 5 months, it might be a very good time to buy. A little bit of preview on the silver yearbook. As I said, because of silver, of some of the things that are going on in the silver market, and because there's been a rise of misinformation being spread about silver, we've added some extra discussions, analysis, and statistics, charts, and tables to the silver yearbook. Silver yearbook will be launched with a briefing. Anybody can sign up at the bottom. You can see order the yearbook at the very end of my presentation. I'll show you the link where you can register to plug yourself into the silver yearbook briefing webinar next Tuesday, the 11th. This was excerpted from the silver yearbook, and these are the reserves, mineable reserves, and what they call the reserve base. And the reserve base, actually, this is data that was provided by the U.S. Geological Survey, and people around the world use it. They stopped publishing the reserve base after 2008, 2009. But the red bars are the reserves, and those are mineable reserves. And it's very important to understand the difference between reserves and resources. You know, resources are, reserves are ounces of silver in the ground that are profitably mineable at current or near current prices. Resources are ounces of silver in the ground that could become profitable in reasonable expectations of future prices. Geologists don't use $100 or $200 as a reasonable expectation of future silver prices, by the way. They use more reasonable and credible price expectations. So what you have is an interplay between reserves and resources. And there are far more resources than there are reserves. And as the price of silver or any other metal rises, some of those resources become reserves because at the higher price, they are now mineable. And one of the things you've seen is since the early 1980s up until now, we have higher silver prices. We also have improved refining and recovery technologies, which allows you to mine a lower ore grade. And as a result, we have about twice as much reserves today as we did at the beginning of the 1980s. When Jerome Smith in the early 1980s said the world was going to run out of silver and the price would go to $100 by 1985, he was looking at a reserve base of less than 8 billion ounces. Well, that's changed, and the price rose and the reserves have doubled. So we have several tables and charts on that here, and this is kind of complicated. I'm not going to bore you with the details. The whole table is in the Silver Yearbook, as is a discussion of it. But you can see in 1981, the USGS was not publishing reserves, but they were publishing a reserve base figure, and it was 8 billion ounces. And that's what Jerome Smith was looking at. He said, well, 8 billion ounces, 800 million ounces of mine production, we're going to run out of silver pretty soon. Not realizing that the price had gone from, $1.29 to $50 to $5. And at $5, a lot of those resources would become reserves. By 1988, they were publishing reserve levels, and it was 7.8 billion ounces of reserves, and resources had risen to 10 billion ounces. By 2020, you had 16 billion ounces of reserves, and they had stopped publishing the resource base. And we have the compounded growth rates and the percentage changes from period to period. And then on the right-hand side, okay, what about mine production during that time? Well, you can see from 1988 to 2008, 10 billion ounces of silver was mined. From 1988 to 2020, it was 19 billion ounces. Right? So you start with 1988 and you've got 7.8 billion ounces of reserves. You mine 19 billion ounces, and at the end of the period, you have 16 billion ounces of reserves left. So the world's not running out of silver, and it's all in the Silver Yearbook, and it's explainable. Another thing that you've heard that's just patently wrong is, we've seen a sharp decline in the average grade of silver ore, and that's a sign that the world is running out of mineable silver. No, it's a sign that the price of silver is rising and technology is improving, allowing miners to profitably mine a lower average grade. So in 2005, the average grade was 13 ounces per ton. By 2020, it's 5.8. That's less than half. It's off 55%, right? And the average price has gone up 184% in nominal terms. And the value of a ton of ore has gone from $94 to $120 a ton. The decline in grade does not represent the world running out of silver. It represents improved technology for recovering silver from ore at a lower grade profitably and the higher price. It's all in the yearbook. It's all explained there. In our discussion about silver inventories, this is, all of that I was telling you about has to do with mineable silver, silver reserves and resources that are inventoried in the ground, unprocessed, unrefined, unmined. There's also silver that is in inventories that has been mined and has been refined and is lying around the world. And we have gone through those numbers and we've improved them. We have written in our Silver Yearbooks for several years about some of the issues that we were researching, and we've managed to finish that work and we explain it. In explaining silver inventory levels and the secrecy that surrounds and has always surrounded silver ownership globally, we also threw in a brief history of the silver market research, explaining where these numbers come from and who does it. When I started in the business in 1978, 79, I had been a journalist, in 78, 79, I was still a journalist. I had been a student studying commodity markets, and then I was a journalist writing about commodity markets. And there were two companies that published annual estimates of supply and demand and inventories on silver. One was Handy and Harmon, which was a refiner and semi-fabricator of silver products. And the other one was J. Aaron and Company, which was a commodities trading company. And you can see the little books on the right hand. 1993 was the last silver yearbook that Handy and Harmon put out. And the red thing you might not be able to tell, that was a 1949 Handy and Harmon book. Their books go back to the turn of the 20th century, the beginning of the 20th century. And those two companies produced the data. Other people weren't there. 1983, this is the September 1983 J. Aaron Silver Report. I went to J. Aaron in 1980 and started running their research department. J. Aaron was bought by Goldman Sachs in 1981 and 1986, 35 years ago this month. We spun out the commodities research department from J. Aaron Goldman Sachs and set up CPM Group because we wanted to be an independent research company. I had actually first proposed the idea of spinning off the research department in 1984. Goldman wanted us to stay exclusively theirs, so they gave me a raise and a physical and some cookies and an extra week's vacation and an extra bonus. And I stayed for another 18 months until I was able to convince them to let me do this. And we did the deal. For 3 years, we were their outsourced commodities research group. And then we moved on and did other things. Handy and Harmon, meanwhile, said, well, if you're no longer part of J. Aaron Goldman Sachs, we don't need to publish our research reports anymore. You can handle that from now on. So they stopped publishing their reports after it was clear, after about 7, 8 years, that we were around. To give you a timing on that, 1986 when we started CPM Group. And by the way, despite what you might read in the yellow press, I didn't borrow any money to affect the management buyout of the research department. And I actually didn't switch from Goldman Sachs to JP Morgan. We looked in our records and I don't think we've ever been paid a dime by JP Morgan. We've cost them a lot of money in terms of doing deals for our clients, mining companies, industrial users, and fabricators of precious metals and investors, negotiating better deals for our clients with JP Morgan, but they've never actually paid us anything. So don't believe what you read in the press or hear in the press. That said, just put it in context, 1986 CPM Group started. That was before the World Gold Council existed. It was before the London Bullion Market Association existed. At the time, there were two companies that produced gold research. Consolidated Goldfields was a mining company and had a research operation, and CPM Group / J. Aaron Goldman Sachs. And we were, I guess, no, Johnson Matthey started publishing platinum data around 1985. We started publishing it in 1981, shortly after I came to J. Aaron. But that's a brief history of silver market research and gold and platinum. Not a lot around, and gold and silver are very secretive markets, and they are both those things that people think they're experts on, but they really don't know what they're talking about. We will launch our silver yearbook on Tuesday the 11th. I hope you all join us for the live webinar. It will also be recorded and will be reviewable. You can register at this link here below at our website. You can order or pre-order the book. It'll come out as an ebook on the 11th. You can order the gold yearbook. We are moving forward with the open forum on silver. We have lined up 2 people who will be interlocutors, and one will screen questions that we'll take from the broader audience, so that we, and they're independent people. I think people will be surprised and impressed by who we've gotten. And we've told them, look, we don't want nonsensical questions, but we welcome intelligent and tough questions to answer. We're going to be there to try to dispel some of the myths and nonsense that you hear in the silver market. And then we will be starting our challenge your assumptions probably in June. That's all we have for today. Have a good weekend. Enjoy the spring if you live in the Northern Hemisphere and you don't have a tornado coming down the pike. And we'll talk to you next Tuesday when we do the Silver Yearbook. Thank you.